Hi, Paul Gerard from Price Accounting Services back for this further video concerning joint loan interest deductions. So we're going to explain what the problem is. In September of 2025, the ATO updated its website quite discreetly and only to the tax agent section of its website. In that, it took a view for a new view or an emerging view, an altered view, to a matter which has always been subject to some dispute, negotiation and discussion. And it concerns where there is a joint loan, who claims the interest deductions. Now, many of you out there will say, well, it's based on their legal interest in the investment and blah, blah, blah. Let's put that aside for the moment. We're going to talk about the loan itself and that interest concern. So the view taken from September 2025 is that interest is legally incurred when the loan is taken out with your lender and refinanced and so forth. So this creates a difficulty when you have one investor and two borrowers. The ATO view is that the borrowers themselves legally incur the interest expense, for example, half-half. So that if one of them is the investor, they can't claim 100% of the interest deduction, they can only claim 50%. Also, the other borrower has incurred 50% of the interest, but they have no income. So Section 8.1 of the Income Tax Assessment Act connects income and deductions. And it says, well, if you don't have income, you don't get a deduction. So the resulting problem is 50% of the interest deduction is lost, or the borrowing expenses. So that's the basic problem. Now, it goes further. Many people will consider the structure of the ownership when they buy a property. And they might say, well, my husband, he earns the highest amount of income, so therefore we'll put all the property in his name or the shares or whatever it might be, okay? This isn't confined just to property. So let's say they do that and it's a joint loan. The ATO's view is very clear. Where there are joint borrowers, one may have only done so because the bank requires it to be that way because of the servicing on the loan or the loan security, whatever, okay? Still the problem. That's what the ATO has designated applies. So the problem here is, in order to get a full interest deduction, the ATO has only given one concession. And that is, and again, it's a newer view in that they've introduced this concept of a legally enforceable written agreement between the husband and the wife. Now, I'm not talking about on lending money. Put that aside. I'll explain later why that fails. I'm talking about agreeing that the loan taken with the bank, we're going to have a side agreement, and the side agreement will say that, for example, the wife says, I'm not the investor, you are the husband, so therefore you're going to claim everything, and they're going to mutually agree to this. Now, this is a bit of a legal nonsense that's been raised by many solicitors who have looked at the problem, in the terms that you go to a bank, you have a borrowing agreement, you sign it, mortgage, all those things, right? And then at the very same stroke of a pen, you're signing a side agreement which says the complete opposite. Instead of the loan being a joint loan where it's legally enforceable upon the husband or the wife or both, so there's three ways, then they're saying, well, we're going to ignore that. We're going to say that we're going to disregard what the investment was. It might have been that you fully intended and agreed that the husband was going to use all of the proceeds. So they're discarding that. So there's a lot of legal dispute about this, and until it's tested in a court, the problem remains you have to have a fix. So we're going to walk you through the fix in one of the later videos. Now, let me explain a little bit more of the history to this. So this is the view that came about on their website in September of 2025. And if you want to go to that website, you can go to the ATO, www.ato.gov.au, and in the search bar type in QC 105353. That will take you directly to the apportionment page, which explains apportionment of deductions, where they talk about the interest being apportioned. Okay. Now, that was the view in September of 2025. I was contacted by somebody who was suitably affected by an audit decision concerning this issue. And it roused some curiosity because for many, many years we haven't seen it. But for the last couple of years, the ATO has literally had a massively expanded audit budget. So they've got loads of people. Their only job is to audit people. Property, shares, the lot. Interest deductions are usually very attractive to the ATO to look at because they're high value. Okay, so whether it's a trust-related interest deduction at item 13, for example, from a fixed trust, or if it's shares, ETFs, you name it, property, and so forth, it's all affected. Okay, so what is a joint loan? Okay, a joint loan is a loan taken out by more than one person. Simple. So you need to look at the names of the borrowers, and it typically will be husband, wife. Rarely you might see it husband, wife, and a parent. That's going to be a difficult one. We'll talk about that later. But in the context of any deduction, it's then a case of, so what are the ATO really getting at here? How do we fix it? Well, that's going to be a difficult thing. We're going to talk about it in a later video. But in the context of the audit issues, the ATO has looked at objections and denied them. So the only avenue available to a taxpayer is to appeal, which means going to the Administrative Review Tribunal, which I'm going to say it's a court, but it's not really a court. If they find contrary to the ATO could dispute it. It gets escalated to federal court. So we're talking a very, very costly issue. Okay. Also, in terms of the context of the ATO audit actions, they will look at auditing 2 years, even if it starts out just looking at the present year. When I say present year, the year most recently lodged. They then may expand that to 2 years. They generally won't go beyond 2 years. They've said that. However, in some situations they can go a bit longer, but that's generally not going to be in their policy. So in terms of the interest deduction, we're also seeing average interest deductions to these affected loans being in the $10,000 or $20,000 range. And if we're talking 2 years and high marginal tax rates, you can be looking at an audit amendment cost in the range of 10, 15, 20, 25, 30,000. That other taxpayer I spoke of, 45,000. Okay, so we're not talking immaterial amounts. So what I want you to do, if you think you have a joint loan, watch the next video. Okay, we're going to walk you through step by step. So those who aren't affected, leave us now. You don't need to keep looking. You might want to watch only to learn from it, so your future loans, should you have one, are compliant. Okay, we will have a separate video on that joint loan borrowing issue, standalone guidance. But for now, if you're interested, watch the next video and we'll see you then. Cheers.